Hello and welcome to the Physicians First podcast, where you, the physician, comes first. Our goal is to help you defeat physician burnout, become the best version of yourself, and practice medicine on your own terms. We'll do this through optimizing your health, wealth, and well-being. I'm your host, Jeff LaFont. Let's get started with the show. All right, welcome back to the Physicians First podcast. We have an awesome guest today, Dr. Amir Baluch. So Amir is an anesthesiologist. He is an author, I think, of 3 books at this point, probably in counting. You seem motivated enough to keep writing. You're a serial entrepreneur, founder of Baluch Brothers Capital, and I think probably even a couple other companies that you can fill us in on. Financial Wellness MD, I think, is another company that you have. My understanding, Amir, is that your mission is to help 10,000 healthcare professionals achieve financial freedom and better work-life balance through strategic passive income investments and high yield investments. Is that true?
You got it.
All right. Well, welcome to the show. I'm sure I missed a lot in your introduction, but I'm sure the audience would like to hear, who you are and why you go from physician to serial entrepreneur and how that all happened.
Got it. Yeah. So, like you were saying, I'm a semi-retired anesthesiologist, and the path to get here was pretty windy, I guess you could say. In fact, I didn't even think I would become a doctor early on in my career. So, actually, unlike most people that are listening here, I did not get into medical school the first time I applied. And so I thought, well, let me do something else. I became a personal trainer, a nutritionist, and I was reapplying. I started my first business, lost my life savings doing door-to-door sales for electronic payments. And I was like, let me just run back to safety and live with my parents for a while and just keep reapplying. And then 2 months after that, my dad, who's internal medicine doctor, uh, by the way, he used to also do his own colonoscopies and EGDs on our
Oh, really?
sedation, but it's internal medicine.
Yep.
Now, that was
There,
back those the old school days.
there
So
were a
he
couple around
actually,
here until recently that did that, but I think
oh,
I think they phased out at this point.
right, right. So he was doing that, but unfortunately, he declared bankruptcy because he wasn't planning properly.
Mm.
He didn't have good advice and maybe over leverage here or there. So we moved to a 1 bedroom apartment that was about $250 a month. Just lucky to get some hot water for 5 minutes a day. And, we just started to regroup and figure out what was important to us and what wasn't. In the meantime, as I was working miscellaneous jobs like librarian and personal trainer, I did get into medical school.
Librarian in
And
the middle
so,
of that?
yeah, I was because, I would get paid to read. Like most of the time, I'm just signing people in. So,
Hmm.
I was getting like $6.25, getting some homework done, things like
That's
that. So,
smart. Yeah.
yeah,
Work
yeah.
study.
That's what it was. It was a work
Yeah.
study program,
Yeah.
actually. So a bunch of odds and ends, weird type of jobs. But during this time, I was trying to find out, okay, well, how am I going to survive? Like, how are people becoming millionaires and retiring early if that was a goal of mine? And so I looked into real estate. I joined a bunch of masterminds. I read over 300 books, most of them on audio. That's the way I like to read. So free audio. And then
How
eventually we
did
did
you ever
close.
Amir, did you ever calculate how many hours that is? It's got to be
I
a
have no
tremendous
idea
it's got to be a
because
tremendous amount if it's 300 books. I mean, that's
so
crazy.
so in the year 2000, which is when I started
Oh,
this, they
you had
didn't
it.
they didn't have a
Yeah.
lot of abridged ones. They were
Yeah.
6 hours. Then eventually I found the abridged audiobooks, which are 2 hours. I started doing more of those.
On a CD or a tape and it's scratched and
It was
it skips or
CDs.
whatever. Yeah.
Yeah, yeah. I had to hold the CD holder in my car like this so
Yeah.
for the dips.
You
So
were the anti-skip technology. Yeah.
yeah, yeah.
That's great.
So that's back in the day.
Yeah, man.
So it's a lot easier now. Let me tell you, all the guys that didn't have to drudge through the snow those days to learn a thing or two. But eventually I did learn a thing or two, mainly from getting mentors. So like 5 years later, when I was in medical school, I think I was a second year, invested into my first multifamily deal at the age of 25 through my college roommate who became the head of finance for a large private REIT in San Antonio. So we did really well there. And then a few years later, when I was in residency, I was trying to build a gas station and commercial strip in Dallas. And we didn't close on that one, but we did close on a short sale flip, made 17 grand. This was while I was in residency trying to figure out, hey, well, am I even going to finish residency? I didn't trust anything at this point. so, so I was just looking at other ways to do things. And then I realized you need to have some mentors. And so with mentors, we kind of, went even further along to 2010 when I came to Dallas to start private practice anesthesia. Within a year, I got my real estate license, started a real estate brokerage, and got my securities license, a 63 and a 22, and joined a boutique investment bank where they had a broker dealer arm and an M&A arm. So I spent most of the time on the broker dealer arm. What does that mean? Broker dealers, they basically sell securities. What is a security? It's a pooling of money of passive investors and put in the hands of a manager. Starbucks, for example, is a public security. Tesla is public security. So we were doing that, but in the private space, doing private securities, mainly, real estate. We did almost up to $1 billion in transactions with hard money lending, fix and flips, and multifamily. And before I left on my own to create Baluch Capital in 2016, mainly driven by a lot of physicians asking me how to get involved with projects and asking for advice, which is actually the reason I wrote my book. So all these things that I did were kind of solutions to things that were happening to me.
Hmm.
So if you want to talk to me a lot, let me put what I have in a book. People want to do, partner with me on deals. Okay, I got to do bigger deals to accept everybody. And so, we worked on that. I pulled my brother out of his MBA courses and said, hey, that's cool and all, but I need help building this real estate development company. I can't be in the OR and run to
Hmm.
title to get permits
Hmm.
and manage the property as a GC. There's some limits to what I could do. So
Hmm.
he helped there until we created Baluch Brothers Development. And since then we diversified into private equity funds, some tax strategies that we offer every now and then, and some fixed income products like 12, 15% preferred returns as a fixed income product against hard assets. And that's kind of where we are. So now just as our capital partners ask for this and that, we kind of move with the times and create opportunities for everybody involved, and hopefully get enough passive income for people where if they want to retire early, they could.
Hmm.
But my goal is if people can just go down to 4 days a week or something like that, get a little bit more work-life balance, but still have that purpose. I mean, you went to school for, a
Hmm.
decade and a half plus or minus. Don't lose that sense of purpose, but pull back the time so you get some balance and not get burnt out.
Well, I appreciate you summarizing that. You've had a heck of a path, and done some really, really interesting things. I wonder, I could barely get through getting to the hospital. Rather, like I don't know how, when I was a resident, I don't know how the heck you were interested enough or had the time or ability or drive to learn about real estate or try to do some investments on the side. Um, was that a result of your father's situation and what you saw there? Was there fear driving that, or is it just it's something that recharged you and you found super interesting, or what was the motivation there?
I think part of it was the fear of losing, especially in my early 20s. And then in my later 20s and early 30s, it just became a kind of a part of me to just always be diversified in my skill set. And now with technology moving so fast, it's even more important to be adaptable and have multiple skill sets. So now I just do it because it's fun and that's kind of my personality. But back then, like you were saying, I think it was kind of driven by some fear
Hmm.
and necessity too. I
Hmm.
was scrambling for something to grab onto.
Hmm.
I didn't know what was going to happen. So
Were you a fairly entrepreneurial minded kid, or did that develop as a result of kind of, your initial investments in learning?
yeah, I wasn't an entrepreneur at all really that much. I think I did get some courses on, how to make money over the summer when high school was out. So but very small things like that. I was flipping burgers at the mall on weekends, and I would, buy and sell auto parts. A group of my friends, we like to soup up cars and put on
Hmm.
superchargers and redo the exhaust and all that stuff. So I would do
Back
some
in the Fast and
wholesale
Furious
things.
heyday, huh?
Basically, it was like that. I
Yeah.
did have an eBay store. I
Mm.
was wholesaling supplements because I was big into supplements after I became a personal trainer. So, you know, and I was making good money, 3 to 5 thousand a month as a medical student. Actually, I kept that going for a couple of years. So,
Mm.
but just being diversified and being more aggressive in those, I guess, side businesses would turn into main businesses. That aggressiveness happened after all this bankruptcy stuff and these downfalls and not getting into medical school.
Hmm. Now, you mentioned retirement, and we talked a little bit about it before we started recording the show. Um, can you tell us a little bit about, it sounds like you stepped away from medicine for some period of time, and now you're practicing part time. Can you talk us through kind of your feelings about that and why you ended up going back to practice and just the thought of like investing to retire if you're a physician? Tell us about the psychology behind that from your experience.
Yeah, so I was actually a little bit scared of it because, I was thinking to myself, why would I retire? I like to do anesthesia. I never felt like I worked a day in my life doing anesthesia. It was pretty much always fun, unless, you have a 2 a.m. C-section, those might kind of suck, but
Hmm.
or a 3 a.m. gunshot to the chest, like you gotta do what you gotta do there.
Hmm.
But other than that, it was really fun and helpful. And so I started part-time first, just doing 8 shifts a month. I did that for maybe a year and a half, and then before I went to doing nothing for about a year and a half, and then kind of it just felt like something was missing. And I think that just being social and being around some people and having that kind of team sport that you have in healthcare,
Hmm.
it takes multiple people to take care of a patient. All that stuff was gone, and it was kind of cool. Nurses laugh at my jokes even when they're not that funny. These little things, free food in the doctor's lounge. I started missing these things. So,
Yeah.
you know, so I think going back to do 4, 5, 6 days a month is kind of where I need to be, and that's where I'm at right now. And there's so many people. They're actually asking me, Amir, why don't you just retire? You're doing this, you're doing that, and I kind of did want to try it out, but I knew, one of my mentors actually told me the reason for retirement. And I don't know, Jeff, if you know why retirement was created. Like in other countries, they don't really talk about it that much, but they uh, they were they were wondering. I think it was, I don't know if it was the 20s or the 30s, sometime during one of the world wars. They were thinking, hey, all these kids coming out. Uh, they're not going to have any jobs because the older people with more skill and more experience have taken all the jobs. So
Hmm.
they created retirement. Hey, save up some money and leave the workforce. You got to leave some jobs for these kids coming up.
Hmm.
That's actually why retirement was created originally. And your 401k, by the way, while we're on it, 401k, the government was kind of pulling away and thinking, hey, let me just give everybody pension funds and that's it. They created the 401k basically so other people could have the responsibility of dealing with that instead of the government. It wasn't so this whole idea of retirement did not come from the people of America thinking, yeah, work really sucks. Let me make a plan to stop doing it. I think if somebody thinks their work sucks, they need to do a little bit less of it or do something else, do something
Hmm.
that they like, find their ikigai. So,
Hmm.
but I tried it. I tried it and it wasn't very fulfilling. I mean, it was cool to wake up whenever I want, like on some days. But
Sure.
even that got old, and now I even wake up earlier than ever. I wake up at 4 a.m., which is the opposite. When I was full-time anesthesia, I wake up at 6:15 and wash my face and run out the door.
Hmm.
So it's kind of interesting when you get motivated to do something. Uh, you end up waking up earlier than before, and this whole idea of retirement, so you could sit on a beach and all that stuff. I think the novelty of that idea wears off pretty quickly.
Yeah, and if you're not growing, you're dying, as they say. So, at some
Right.
point you have to pay attention to that. I'm just curious, do you show up to the hospital a different physician than you did before, now that you know that you're financially secure and you don't have to be there? I mean, what's it like?
Yeah, it's a lot more fun. You're kind
Hmm.
of laid back, and and most of my anesthesia career were kind of production given, like driven. If you weren't doing a case, you weren't going to get paid. And so if you don't worry about that much about the pay coming in based off of your production or your RVUs,
Hmm.
you just kind of work when you want to work and because you like to do it, and you could do a little bit. We're looking at anesthesia. I know if you have like a clinic-based thing, it's not as easy to pull out, but
Hmm.
anesthesia, emergency medicine, things like that, you could clock in, clock out. So you could really find some good PRN jobs and decide how much or how little you want to work. So I found a pretty good balance for me.
Yeah, that's part of the struggle. I mean, in GI, I told you I'm a GI physician, and so I do clinic based, and I do a lot of endoscopy and colonoscopy. The issue is our specialty is very there's a lot of homework, one of my colleagues said. So we order imaging, extensive blood work because people have anything can cause belly pain, right? From allergies
Right.
to whatever. So we're ordering scans, we're scoping, we're doing pathology. And so our inbox, when I leave work, there's way more work to be done. I'm never actually gone. Now my wife is a radiologist. When she leaves work, she's done. She doesn't even have to think about it. So I think with other specialties, it's harder to try and figure out how do you tweak your schedule, how do you make it more enjoyable. And I do believe there are ways, and a lot of them seem like we overcomplicate it. How we adjust our schedules or dictate notes or use AI or things like that. I think we just get so overwhelmed and busy that we don't take the time to just hit pause and try and figure out how to
Right.
get around the pain points. So you threw out a lot of words that may intimidate some physicians when you came on, kind of securities and private equity and things that are second nature to you at this point. But let's say that there's I don't know, an internal medicine physician who's feeling a bit overwhelmed right now, is not sure how much longer they can keep their current pace up, and they want to learn about this. They want to know more about investing and how to secure their financial future without just investing in mutual funds and hoping they survive till they're 70 and can cash out and the market's okay. Like, where would you tell that person to turn? You mentioned some mentorship, you mentioned masterminds, which have become more common, but where would you start with that person?
Well, first I'd want to know kind of what their goals are and work backwards. So, for example, let's say if the goal is to go down to 4 days a month, you need income for that fifth day, which is 4 days a month. And what do you need for that? Is it 10,000 a month? And
Hmm.
then now how much money do you have to invest at what return to get that $10,000 a month? And let's make that goal one and let's see how we can get there.
Hmm.
And then, if I spoke to them, they want to know the fast way, or they want to know the long way, and we can compare the traditional way, which is, traditional investments really don't spit off that much passive cash flow. It's more like you just
Hmm.
kind of build up, build up, build up, and now you got to do something when you're 65. But I would go through the whole spectrum of what they could invest in, what their risk tolerance is,
Hmm.
what opportunities they have in the private markets versus the public, and see what kind of resonates with them. So, for example, what if I let them know buying a business down the street for three times its net income, which, the inverse of three is 33%, getting 33% return on your money. That's a lot of cash flow if you put 100 grand into that, right? Or a
Hmm.
couple 100 grand. And can they get into something there that might be in the medical space? Now they might be comfortable. What if
Hmm.
internal medicine wants to buy into an existing pharmacy? Well, they kind of know the types of drugs involved. They see on the pro financials, how many patients are coming in a month. Maybe they're able to refer to them or be the face of the pharmacy. I don't know. Don't ask me those legal questions about that, whether you can get involved or not. But I just think it's
Star Claus.
right, right,
Yeah, yeah,
right.
yeah. We'll caution
So
everybody about Star Claus, but yes.
right, right. But you can look into those different options and see if something resonates, or maybe you have some
Hmm.
experience, or maybe just an interest in it.
Hmm.
Right? What if somebody is super interested in selling online or having a coffee shop, and they could buy into those industries? That's a cool thing about private equity and private businesses. You could buy into what you want to
Hmm.
do, versus starting from scratch, which has 80% chance of failure, and
Hmm.
then another 80% chance of failure to last 5 years, what's the chance you're going to be in the 4% in business your
Hmm.
first, shot out the door? It's probably not very high. So it's better.
Hmm.
So I would explain to them that. Or, if they want to do something more conservative, getting cash flow from real estate backed assets is another way to go. Definitely more cash flow than the public stock market spitting out dividends, but not as much cash flow if you bought your own,
Hmm.
small business. And then there's also some fixed income products too, but the returns might be a little bit lower, but you're getting those monthly or quarterly checks. So it could be like an 8, 10, 12% type of a yield on a promissory note, either backed or not backed by a real asset. It just depends on what the appetite is. So there's so many things. I mean, almost every industry has a different way to invest into it. I would just show them what the options are and make a plan and then get some feedback and go from there.
Yeah, you made me think. One thing that I didn't realize until the fairly recent past is that just being a physician, most of the time you're what we call an accredited investor. And I don't think most physicians know what an accredited investor is, but it does open doors to unique investment opportunities that the general public actually doesn't have access to, which is some of the things
Right.
you were mentioning. You start thinking about syndications and things of that nature. And so I would encourage people to read a little bit more about what it's pretty simple what an accredited investor is. But once you can approach that and learn about it, these are some of the opportunities you're mentioning. Now, business buying is hot right now. I mean, everybody's talking about it on social media. You have a lot of business owners retiring, and unfortunately, a lot of those businesses will close unless they find a
Yeah.
buyer. And so it makes a lot of sense for learning about that and trying to acquire a business and get high cash flows. But that's pretty intimidating, I would say, for most physicians who feel like they're not necessarily business savvy. So if someone was going to approach that, what would you recommend uh, to them?
Well, they can do kind of what I did, which I would partner with the
Mm,
top consultant I could find in the nation, which is
yeah.
literally what I do on LinkedIn. I find the top guy. I don't care what his hourly rate is. It could be $1,000 an hour. And I've dropped a couple of grand in consultants just to find out that I should say no to a deal.
Mm, hmm.
So that's what I've done before I got into certain industries. But then if I really like certain industries, like for example, in e-commerce, I put together my own team of experts. We have about 40 employees, but we can kind of do almost anything in that world. And in real estate too, we put together a team of I don't know how many people, uh, commercial and or residential. We have teams for both. So those two things I think I have pretty good control of. And if I let's say if I wanted to go into, we're mentioning coffee shops, I would want to find somebody that probably created and sold a chain of coffee shops and then maybe take him out to coffee and say, hey, how
Yeah.
does that work? Or what do I need to get into? I want to buy this one. And I would maybe get the information from free if he's a very helpful person, or I don't mind paying an hourly rate, or if the value is really necessary, why not carve out some equity for that person?
Hmm.
Some people have done that for me as a consultant. They'll give me 10% equity in a deal just to be on the board and make sure things go the right way when it comes to high level decisions. So bringing somebody in who's an expert in the industry you want to get into will save you a lot of headaches, but it does cost money and time. And at the end of the day, you might still say no to it, but that's better than saying yes and then
Hmm.
losing,
A
right?
lot.
'Cause you could,
Yeah.
yeah, yeah.
No, it's
So
yeah,
it's
it's great
worth it.
advice. That's great advice. Uh I think doctors are used to being in control and kind of like the alpha in a situation a lot of the times. And so I think the idea of that you start thinking about these ideas and then you may panic and say, I don't know enough about this. And then you say, well, you could partner. Well, then I'm giving up some of my equity. And why am I doing it if I'm giving it up? It's kind of like this cycle that you have to break and say, hold up. Is it better to have 80% or 90% of something or 0% or
Yeah.
100% of nothing, basically? And I always find that interesting. I've had to stop myself, which is why, I've become much more comfortable with partnering in kind of these different opportunities that I'm investing in, like assisted living, because it's so much more comforting to have a second set of eyes and somebody who complements your strengths and has experience where you don't. And one of the other things I struggled with initially is you mentioned, trying to find the top expert or whoever's really good at something or has a great reputation and experience. A lot of people will say, well, hey, don't be the person that asks them out for coffee. Everybody, you're just taking from them. You're taking from them. Bring them value. And you go, I don't know how to bring them value. I mean, I've literally told people though, I said, hey, I'm a GI doctor. I can tell you this. If you have a question about GI or you need a procedure in my local town or you need to get in with somebody, I can at least provide that. Now let's sit and have coffee. But I think it's interesting to think of like, hey, how else can you bring value? And it may be giving away a little bit of equity if the deal is really that viable and interesting to you. So I think that people should become more comfortable with that because if you look around, the vast majority of very successful businesses, I would say, I'm guessing, I guess I don't have, there's a lot of partnerships behind them.
Right,
And so I
right.
think having a comfort with that, and then you can still do your day job, and you can find if you find the right partner, you can get something off the ground that will set you free financially. You know.
Right. And the big box guys, like I work with a chain of low testosterone clinics called Game Day. I mean, they're going to be pretty quick to give some equity to the right people.
Hmm.
And a lot of these tech companies too, they know that having the right people on the team means a lot. And if you want to retain those people, you're going to have to be ready to give up some equity so they show up to your phone calls. And not only that, but now you have financial incentives that are aligned. So when this person shows up to the board meeting or
Hmm.
the weekly meeting, they are really going to give the best advice because they will be a little bit financially driven to see your company succeed. They're not going to do the minimum possible. They're going to be closer to the max possible to make sure that their shares grow with the
Hmm.
company, right?
Hmm.
So many reasons to give equity. And at the end of the day, it's like you said, it's better to own a portion of something that's actually super successful than 100% of a dud.
Yeah, exactly. Um, well, one thing, obviously, you have expertise in many areas, but real estate is a huge one for you. And I was wondering if you could comment a little bit more about you were mentioning opportunities for investing and if a physician wants to just kind of dip their toe in real estate and maybe get some solid returns or fixed returns, what does that look like? What knowledge do they need to have? How do they vet such a deal? And what kind of returns are they looking at, say, compared to just, mutual funds or something like that?
Well, there's definitely different degrees of vetting and different asset classes inside of real estate. What I'm going to do is I'm going to break it down a little bit so people get the big picture and
Hmm.
then kind of zoom in because sometimes people just they hear multifamily or something at the doctor's lounge and think that's the only thing. But
Right.
we look at real estate, which is let's go even further back. Let's say we have alternative investments. Traditionals over here, stocks, bonds, mutual funds. Pretty much people understand that. In the world of alternative investments, you could break it down into real estate, private equity, which means just private businesses, and
Hmm.
then private credit, which is like fixed debt. You can even call it debt. If you lend to somebody at interest rate, like a bank, that's debt.
Yep.
So out of those three, now we're going to go to real estate. Now,
Got it.
under real estate, you have commercial and you have residential. Under commercial, you can have multifamily, industrial, storage, retail.
Hmm.
You could put hospitality under there. Under single family, you have your regular rentals. And now we have a hybrid, which is what my group focuses on, called build to rent communities,
Hmm.
where we build a whole subdivision of single family homes, but just to rent it. And it's all optimized for renting. So
Wow.
we build a community of single family rentals, right? Imagine there's some people out there that they can't afford a home, but they don't want an apartment complex. They want a backyard
Hmm.
detached from their neighbors, but still have some amenities like a multifamily. That's kind of what we focus on. So all those things have different valuation methods and different rates of return, and you can make the returns better or worse depending on how you underwrite them. And that's a whole other category. Most physicians won't get there, but we'll talk about that in a second. So in commercial, the average returns, at least a few years ago, was 14.2%. In the single family, it varies a lot because there's so many different levels of leverage, how much you want to borrow from the banks. And it's so dependent on that single physician's credit score and the area they're in and things like
Mm,
that.
mhm.
That could vary a lot, but if done properly in the right areas, you could get higher returns in the 20s, even more than that, depending on if you want to do a lower priced homes. The higher price homes usually don't rent for as much, so you get a lower return, but maybe less headaches.
Mhm.
And you have everything in between that spectrum and that single family. So now where would a doctor want to come in? Where's he going to put his big toe in? So I think a lot of physicians can just buy a single rental, maybe even do a short-term rental because there are some tax benefits there,
Mhm.
especially if you're married and having your other significant other managing it. Then all this, there's a whole bunch of tax deductions that come out, which probably do a podcast
Yeah,
episode just on that if you
reps.
want
Yeah,
that. Yeah,
reps. Real
we
estate
do a whole
professional status.
podcast.
We might have
But
to do
that,
that separately.
yeah, that's easily a 20-minute conversation, but
Easily.
that's
Yep.
that's the least of it's the least amount of money. You're using your own bank. You don't need to bring in a general partner. You should find a manager. So that's one way to put in your big toe in the water. You could also go the commercial route, which you could do small commercial on yourself.
Hmm.
Technically, you could do, a fiveplex or a sixplex. You basically do that on yourself if you wanted to, or you do a 40 unit to 400 unit multifamily, or go into a storage facility with somebody else
Or
in a
medical office
syndication.
space, right? I mean,
Yeah, medical office
yeah.
buildings too. In
Yep.
the office space, medical office is the hottest subsegment in
Hmm.
office. So so a bunch of cool things you could do there. And then you could also be owner occupied in that medical office building. I don't want to make it too complicated, but for
Hmm.
the most part, doctors they should just be limited partners and not try to actively manage it. Because I've seen both. It's way easier to just become a really, really good limited partner than to try to actively manage something you've never actively managed. It's almost like, when you have a bar of soap, they actually say this about physicians sometimes. When they try to manage their money, it's like a bar of soap. The more you mess with it like this, when you look at it, the less you have of it. So just leave it, put it down.
I have never heard
So,
that. That's interesting.
oh,
What a
maybe I
visual.
made it up.
Yeah, I don't know.
So,
Yeah.
but but
I
that's
use a
kind of how
loofah,
it
man.
is.
I don't know. I don't know.
There you go. There's always alternatives, right? So, but if you're a limited partner, it doesn't mean you're 100% passive. You still should do some due diligence, and people can give a data room. So we have a data room. I share a bunch of stuff in there. I even do a background check on myself and just throw it in the Dropbox file for people who want to see, if there's anything on me. So
Nice.
then you got to go through the numbers, and this is where it hurts because it's not easy to underwrite these deals. And even if you look at the numbers, you don't know. It becomes a pretty tedious process to vet these numbers to make sure that it's going to make sense or not. So we actually have an investment committee. Even if I really like a deal, it doesn't mean we're going to do it. I got my underwriters from BlackRock North America. We've got people from JP Morgan Chase Risk Mitigation Department that are on my payroll. We got another guy from Goldman Sachs who's my fractional CFO. And I pay these guys because they're good at saying no to something that I might want to say yes to. And then
Hmm.
vice versa. And then we have a good discussion from like four different viewpoints.
Hmm.
And then when we do real estate, at least we get hyper focused. Like one part of the street could have way different economics than the next one, or you could have a house here that rents for X, and you think four houses down is going to rent for the same, but maybe they're close to a busy street or a loud school, and you can't rent it at all.
Hmm.
So if you're not now, you got to get the hyper local expert in there, and so it becomes like a little bit of a full-time job, which is why it's good to partner with somebody to help you with those smaller things. The bigger things, just looking at some data and the projections and background checks and see if it makes sense and looking at a track record. That's like the 101 of of it. And then the second level is understanding the financial incentives. We talked about that before, giving equity to people
Hmm.
in business to help you. So, if the deal goes well, how does that look for investors and managers? If the deal goes bad or doesn't perform as much, who's getting saved first? Is it the limited partner physician investor, or are the managers allowed to get such a big cut that there might not be anything left if there's a downturn? So that's the second level. And the third level is going to be underwriting, which that's not the easiest thing to do, but I have shown some people how to do that from a distance. And who knows, maybe AI might just be able to do it, throw in a Excel file and it tells you if you should invest or not.
It's
That's
coming.
probably kind of
Yeah.
where we're heading.
Yeah.
It's kind of where we're heading. We do it manually with a team of 4 or 5 people, but those are the different levels of due diligence once you figure out where you want to be in an investment asset class.
So when you're building these developments of single family homes and you're basically your company's holding on to them and renting them, right? You're managing this massive portfolio of homes, I guess. Um, is that a fund that you're taking investors on for that fund? Is that how that's working?
So we've done it a couple of different ways. So if you have a fund, but it's only for one project, technically you could call that a special purpose vehicle, SPV, versus a fund. A fund is kind of like, hey, I have a thesis. I want to buy, class A multifamily in these zip codes that are under managerial distress. And like you're actually selling like a thesis. And then as the deals pop up, the fund is funding them. But they both can be used interchangeably. But the best way to say is have we put together SPVs, and we have. And so that's where we have limited partners and general partners with basically Baluch Brothers Developing, which is me and my brother being the GPs.
Hmm.
Now there's another way we've done it. In fact, we're closing on a deal. Actually, we closed on one deal yesterday, and we're closing another one in 2 weeks with joint venture physician capital partners.
Hmm.
So what does a joint venture mean? So when you're a limited partner, you basically have no say in anything. Hey, send us the money. We'll tell you when you get it back, and give us your checking account. We'll send it there.
Hmm.
Joint venture, you have a little bit more say in it. I did some joint ventures because we've had a couple people throw in $250,000 here or there, and 5, 6 people were done. So in a joint venture, they have a little bit more say and some actual voting rights.
Hmm.
Like, hey, are we going to refinance and rent it? Guess what? Everybody's going to take a vote. Versus a syndication, you're a limited partner. It's not up to you.
Hmm.
We'll let you know what we decide later. And then there's another level, co-GP, where now instead of a limited partner, instead of a joint venture, now you have some significant material participation in the deal.
Hmm.
And I've only done co-GP with one group of people, but they have concrete company. They save us a lot of money. They have hotel background. They have development background too. So when they put in money, we do a co-GP, and actually they're like actually at the property once a month, and they're sharing all of their resources, which actually makes the deal better. So if they make the deal better, they could be a co-GP with us. Uh, and they also share in the liability, and they usually sign on the note. It's more like a partnership,
Hmm.
right? So those are the three levels you could come in at if you're going to put money into deal: limited partner, joint venture, or a GP level thing.
And
So
sorry, go ahead, Amir.
no, you go ahead.
I was just going to ask for those who are interested in the syndication. It seems like that's the most hands off. Like, here's the money. You vet the person, the general partner you're going with. What would they expect for like a tax breaks, for instance? Is that another benefit of investing in something like that?
Right. If there's an existing structure, you can depreciate that.
Hmm.
And it looks like Donald Trump is probably going to uh, reinstate the 100% bonus deduction thing here
I
later
bet.
here. This is
I'm sure. Yeah.
January 2025 that we're talking. Then also there's operational expenses. For example, in our private equity funds, a lot of these companies, as they're growing, they intentionally are operating at a little bit of a loss. Those losses flow through to the LPs. So the K1 partnership distribution is always a little bit negative, which helps for taxes. Even though the value of the companies are going up, those
Hmm.
operational losses are helping offset some taxes. So there's also can be operational losses in our real estate development, right? Because we do have soft costs, we have engineering costs, things like that. So in a GP LP structure, we do push that toward the LP so they can get some tax deductions. But usually in development, there's not that much. We don't have a structure to depreciate. So, unfortunately, there's not that much tax deductions. But fortunately, developments make more than anything else in real estate. So it's kind of like the neurosurgery of real estate, which is why we like it. Then uh, there's also you could 1031
Hmm.
into or out of something too. So when you do close on a deal, if you roll it into a deal, another real estate deal within 6 months, and you never touch the money, it just sits in escrow. You don't have to pay capital gains, although there's lots of ways to get out of capital gains. That's just one way to do it that a lot of people know about. So the tax benefits definitely is a big part of real estate, but there's tax benefits in every asset class. In fact, just last month I did a 3-day master class just on tax deductions for every asset class. So it
Really?
took about three. Yeah, just out of coincidence, we're talking about that right now.
Yeah.
But so like for example, in private equity, if you invest into a small business, which means the value is less than 40 million,
Hmm.
if you hold on to the shares and you don't get any distributions or profit for 5 years, anything after 5 years is tax free up to 10 times your investment. So that's
Wow.
kind of cool.
Powerful.
Yeah,
Yeah.
very powerful.
Well, I know we're running a little short on time. I always think of physicians being kind of risk averse. You've learned a lot of different things. You mentioned that you lost your life savings, although I don't know how much your life savings was at the early on in your ventures, but you had to have taken some licks. Like you've had to taken some major hits or made some maybe not, but maybe some had some unfortunate things happen as you're learning about real estate, private equity, all of these things. Um, what do you say to the physician who's afraid to take that first step, or who tells you, "But Amir, you're putting yourself at risk. There's a lot of liability there." What is your response to that?
So if you want to take less risk, usually private credit is going to be the way to go and being in first position to get paid. So whenever a deal closes, let's say in real estate, who usually gets paid first? Usually the bank.
Hmm.
After the bank is the preferred investors or investors that have preferred shares. They're next in line to eat. Then after that is the common shares or the common equity. And then after that is usually the general partners and the managers. So if you want to go to the front of the line, you could become the bank and do hard money loans.
Hmm.
So you're basically the first position debt holder. And that's one of the lowest risk investments you can do. And in fact, that's the oldest form of investing. If you read the richest man in Babylon, that's basically
Hmm.
how people invested.
Hmm. Yeah.
They look at somebody like he's a pretty trustworthy guy because his dad was pretty trustworthy. I remember I gave him a couple $100 and he gave it back. So we'll give his son a couple $100, but I need 10% interest. That's how lending started. So you might want to look at lending, even peer-to-peer lending, hard money lending,
Hmm.
any lending against a hard asset. So you may want to go there too. And there are some real estate deals where you just get the pref. So in fact, we're thinking about starting a fund, a first position where maybe we raise like 10 or 20 million and we get rid of the bank and we just give instead of paying the bank, which right now charges us around 10% for construction loans,
Hmm.
why don't I give the investors 9% as a prep and they're in the lowest risk position and we could pay that monthly.
Hmm.
Because right now we're paying the banks monthly 10%.
Hmm.
Might as well give it to one of my peers. So we're thinking about that.
Hmm.
If you want to go up the next level, you could do a pref plus equity deal where maybe you get a very low pref, like a 5 or 6%, and then the equity portion is kind of the question mark, will you get it or not, based on the performance
So by
of
pref, you mean preferred return, right?
right, the
Yep.
preferred return, which
Yep.
means you eat first before common shares and managers.
Sure.
So you can decide, we call this, the capital stack. You have the guys at the top, which is usually the bank, and then it goes down to managerial or co-GP levels that eat last. So where you want to eat first, second, third, fourth, the more you're closer to first, the less risk it is. And also usually, all the time, usually that's the lowest return too, usually, high single digits or something. Um, so
You're
that's
very
how
good at
you want
breaking
if
this
you're
down,
afraid.
man. I feel like I need a whiteboard for you. Like you just draw it all out.
I thought about getting one of those buy boards. They
Yeah.
cost like $3,000. It's like, okay, but am I going to use it or not, or just draw on a piece of paper or something? But I have thought about doing a vibe board. I might
Yeah.
do that one of these days.
No, it's pretty good. Um, so with it sounds like you wrote three books. Are any of them on these topics? I mean, obviously you're very good at educating and kind of breaking this stuff down. What are the three books on?
So the first one was called Make It, Keep It, New Age Wealth Strategies for Physicians. And what I did, which I don't think has even yet been done again, but I took the psychology of a physician from right when they get out of residency until right before they were going to retire,
Hmm.
how the priorities change and what they could be investing in. Anything from like understanding your mindset to, hey, here's what you could invest in to, hey, here's how you protect what you have and donate to charity. The second book was a Wall Street Journal bestseller called uh, Expert Resilience, and basically it's just I just have one chapter in there, so that's why I don't talk about it that much. But it talks about if you are resilient in what you want, you're going to get it, and
Hmm.
everybody has a story. Then my latest book called Prosperity Prescription, we actually go into more details about private investments more than anything else. And what's cool there is that at the end of most chapters, there's a QR code and a video of me pops up to go into more detail if you want more detail about something. So I don't think any book has done that, going from video back to book. So maybe I'm the first, but I wanted to make it interactive where
Yeah,
people could
sure.
scan things and go to videos and workbooks and cheat sheets and all that stuff. So
So that sounds like that book is a lot of what you were mentioning during this discussion today. Is that fair?
right. The last one is, and the videos go into way more detail, and then every one of those chapters could be a 2 hour podcast or a 1 day event, actually. So the learning never stops, but at least you can learn the lay of the land and start planning out your next move after
Where
reading
where,
those things.
where can we grab that book? Where can we find that one?
Well, you could go on Amazon if you want and search my name, or we do have a page for you guys here and all your listeners where you could just give your information. We'll send you a free copy of the latest book. If somebody wants what I call a clarity call with me, like a 10-15 minute call, they got some burning question, what do I do? I'm stuck here, whatever. They could have one call with me there. We'll have a link for that.
Awesome.
And
Thank you.
you know, those two things can kind of help get people in the right direction. And people can also find me on LinkedIn if they just need to access to some of my resources. I'm not here offering everything in the world. I know my place, but if somebody needs something else, I've probably come across that issue before. I'm happy to, share resources I have with them.
No, that much appreciated. I'm actually really looking forward to checking out the book and scanning the QR code and see what you have to say.
Yeah, yeah, it
Um,
was pretty fun.
yeah, no, that's pretty cool. And then just for clarity on the clarity call, I guess is that really if somebody is curious about different investment strategies, is that really what we're honing in on those calls, or are you more of a coach, or is it what's the
Yeah, so in the past, what's happened is, people were stuck with something. I've had people just say, "Hey, can you just take a look at this deal? Like, to give a second opinion." I've had some people say, "Look, I've got X amount of millions in the stock market. I don't even know what the next move is. I'm afraid to be illiquid in anything."
Mhm.
So we kind of break down whatever they want to talk about. We just break it down. So, or they might have heard something online. They just want to run it by me. So there hasn't been a single theme for these calls yet. I haven't seen any pattern. It's been kind of random.
Amir, I might mess with you, man. I might just do some like random profiles and like on my drive home from work, just be like, "Oh, it's our clarity call this week," you know.
Right,
Like
right.
I'm just gonna throw some rando questions at you, but no, I appreciate that. I think it's very helpful to have a physician talking about finances, talking about real estate. You're well versed in private equity and all of these different things, and so an excellent resource for our fellow physicians. I mean, who do you trust more? Someone who's also a physician. I mean, physicians always look to each other for guidance, and we're kind of a unique tribe of people, which is why, I think it's super helpful to have someone like you offer at least their ear, and a little bit of advice here and there can go a very long way and change, completely alter the trajectory of someone's career and personal life. So, thanks for what you're doing. Thanks for sharing all that knowledge today. And really excited to see what you guys are doing over there at Baluch Brothers. So, did your brother ever get his MBA, or did you keep him out?
I kept him out. We decided there's no
Why
reason to
waste the
get it.
money?
We're too
Yeah,
far. We're too far in the
yeah,
game right now.
yeah.
So
You're like, man, you want to get paid or do you want to pay for a degree? Is that what you said?
right, right.
Nice.
Basically, yeah.
That's awesome. Well, congratulations on all your success. Thank you so much for everything. Guys, reach out to Amir on, you said LinkedIn, and what are
Yep,
the
that
other,
works.
where's the other places they can find you?
We'll have a link. We'll have a link somewhere on your
Okay,
wherever your
cool.
podcast is launched too.
Yeah,
I
we'll put
think
it in
they
the show
already
notes.
have one for you.
Yep. All right. That's awesome. All right, guys. Well, don't forget to sign up for physiciansfirst.substack.com. Sign up for our listserv, reach out to Amir, and we'll talk again soon.